Well, here's a bit of a puzzle. The US dollar has grown increasingly weaker and weaker, and we have seen some boost in export. So if the value of US currency's fallen so low, you might ask, why don't we have a surplus? Why is our trade deficit so high? So in order to find answers to questions like these, I decided to go to Walmart. Let's see if we can find some answers here. Hello, how are you doing? Let's have a look at some of these lamps here, right? These things are on sale for $7, and this is one brand of a lamp. Let's see, I don't know if we can find any that are made in America. No, this one is clearly made in China, walmart.com. What does this one say? Made in China. What do you think? Made in China. Yeah. I think all these things are going to be made in China. Now, the interesting thing about this is that, look, actually, here's some different ones. That one, oh yeah, that one's made in China too. I think every single one of these lamps in this store is going to be made in China. Now, that might say something to you about the trade deficit and trade surplus situation. The fact that, if Walmart is only dealing in Chinese products and not in American products, well, it's fair enough. There's a pretty good answer anyway as far as why that might be. But that doesn't really address the currency issue, though. If United States currency is relatively, the value of U.S. currency is going down, and that means that labor should be cheaper in the United States, which means that the United States should be making more of these sorts of products and eventually be competitive with the Chinese. And so you might actually wonder, why is it that it's turned out this way? What is it that China is doing that is affecting their ability to continue to be competitive in the United States? Well, one answer, many people would argue, is that the Chinese have been pegging their currency to the US dollar. Now, how does that affect whether or not we have a trade surplus or a trade deficit and what products Americans buy? The problem is this. Let's say that you actually did have an American product in here, and it was like an American lamp was $12 and a Chinese lamp would say $7 or something like that. As long as that currency stays fixed, the two end up being tied together. If the United States, the value of the United States lamp goes up, well, so does the Chinese lamp. If it goes down, both go down at the same time. So there's no way for the American product to ultimately undercut the Chinese. So which one are you going to continue to buy? It's going to continue to be, assuming that you're price conscious, the Chinese product. This is one way that the Chinese have essentially been able to run a surplus for so many years, by fixing their currency to the US dollar. Now, keep in mind that creating a surplus, according to a mercantilist principle, means that you're amassing power. That's a good thing as far as the Chinese are concerned. But the downside of this, though, is that if we were to take all those US dollars that are going to China and convert them into Chinese currency, well, you end up with a lot of Chinese currency running around the economy, which has a tendency to create this inflation. Now, they don't want this to happen, so what have they done in response? Well, they try to convert as few of those dollars as possible back into the Chinese currency. Well, what do they do with those with their currency? They tend to funnel that money into other things. One thing that they funnel it into is something called a sovereign wealth fund. That is sort of a portfolio of investments that is owned by the state, which allows them to continue to make investments not in the Chinese economy, not in Chinese consumer products or anything else that's related to China, at least not to such a scale that's proportional to the amount of money they're bringing in, but to make investments in other countries. So you need aid to Africa or something like that, they can pull that off. Any sort of investment, future business development investment that they want in countries throughout the world, they just spend that money in other countries. Now, what kind of advantages do you guess China might get as a result of advancing these policies? Well, it used to be the United States was doing a lot of this, and certainly that amount has been declining over the years. Well, as that number's been declining on the United States part, it has been increasing on the Chinese part, which means that along with this money that they have, it also wields a good amount of influence throughout the developing world. And it wields a good amount of influence in Washington, too, if you think about it. When we need money for healthcare or for the military or for whatever it is that we want to pay for by the government, our politicians don't have the guts to go out and ask for taxes to pay for this stuff. So how do we do it? Well, we go into deficit spending. So where do we get the line of credit that it takes us to fund our indebted government? Well, largely from the Chinese bankers. And so a lot of the money that we have, that we're basically spending on Chinese products, is going off to China, and they don't want to spend it on their own economy, so they're holding on to it, but then turning around and reinvesting it, guess where? Back in the United States government. Let's say that we want the Chinese not to fix their currency, our currency, anymore. Well, what could we do? Well, the President of the United States could go over to the Chinese president and say, please, 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 could you not do that anymore? And what are the Chinese basically going to say? How bad do you want that big military? How bad do you want healthcare spending? How badly do you not want to tax your own citizens? If you want this line of credit, what are you going to do? Well, you continue to borrow from the Chinese. And so it's this weird sort of codependent, symbiotic relationship going on where China seriously depends on us because the United States consumers continue to buy Chinese products and create this surplus and power that they're resting on. At the same time, we don't want to do anything to try to fix that because the Chinese are basically lending us a lot of money to give American people exactly the sort of product, services, protection that they have demanded.
I mean, China definitely does it for protecting their trade, but there are also legitimate reasons why some countries have gone forward and tried to peg their currencies. Former Eastern European countries, a lot of them, the Soviet Union fell apart, and these countries then became democracies and moved in a more capitalist direction, and they wanted to attract foreign investment, right? And so they have new currencies, new governments, and they want to try to get all this stuff together. Well, how do you reassure an investment community that your currency isn't going to totally tube?
You tie it to the dollar.
You tie it to the dollar or to the euro or to the Deutschmark at the time, or as it would have been, right? I mean, you pick a major world currency and you manipulate that currency so that you take measures of financial austerity or you infuse more money into the economy, but you move that currency around so that it doesn't decline in value substantially. And why is that important to international investors?
Needs to be a return on their investment.
Yeah, exactly. Or at least there's the stability that may come with that currency, so that you're not going to lose a whole lot if that currency plummets, right? You don't want to buy up a bunch of land and buy up a bunch of real estate and do a bunch of investments only to have, inflation go up like crazy the next day because the value of your currency has crashed, right? And that's just a recipe for, a high risk investment. And so that's one thing that's actually helped a lot of those Eastern European countries is that, at one time they were pegging their currencies. And it wasn't to try to manipulate their currency in foreign markets so much as it was to try to ensure that investors could get in there and get good investments.
What happens to the value of the U.S. dollar when we cut taxes? Sort of jump through some hoops, right? We allow more money in your pockets, and so more money gets spent, which means the value of the dollar goes down. Very good, right. So, what would that do to the relative price of our exports overseas?
Make them go down.
They go down as well. Okay, so that means what? That American products are now going to be relatively more competitive in foreign markets than they were before because we cut taxes. Let's say that we're talking about American aircraft parts. Let's say that declines in France. Does that make U.S. goods more attractive?
No.
No, yes? It would just happen to the price.
It makes it more attractive because they're cheaper.
Okay, they're cheaper, right? So you might be more inclined to want to buy American products under that circumstance. What happens to the French aircraft part manufacturers who are buying more U.S. parts? They suffer. Okay, they suffer, and what does suffering mean? Okay, so we got unemployment. Businesses go down, the economy goes down.
Prices go up.
Prices go up. What else? What happens to our poor political leaders of France? Okay, the public gets angry, right? Then what happens? It is a democracy, so people vote. And then Sarkozy does not have a job any longer. It makes me cry. Right? So yeah, it's not too hot for politicians over in France. As more U.S. dollars start going around, that has an impact on the value of the U.S. dollar, and that has an impact on what happens over there. So you got French political officials who are unhappy about the situation, right? The U.S. is cutting taxes, so how do you handle that situation? If you're France, or if you're America and you're about to make your ally mad. They actually have these summits where everybody hangs out. Like you've heard the G8, or like, sometimes you get the G20, you get more of them come together. And what are the purposes of these summits? It's basically to work out those exact sorts of problems. So let's say that the United States and France get together, all these countries get together, and the United States says, hey, in order to produce some fiscal stimulus, we're going to cut taxes next year. I understand that's going to have a negative impact over in France. You should know that. I'm signaling that to you right now. And the French president can turn around and sort of say, okay, well, what are we going to do in order to try to offset that? Because we're not actively trying to screw the French by giving Americans tax breaks, right? We're just trying to set up a situation where we can have an open dialogue and talk about these things. Now, lots of things are talked about at these summits. Oftentimes we've got energy policy, we're trying to cut debt to impoverished countries, you name it, right? One of the big functions that this serves is as a coordination mechanism, because when the United States sneezes, the rest of the world catches a cold. And that's what we're talking about really in terms of the impact of some of this currency interdependence on the rest of the world. And suffice it to say, you can engage in a lot of currency manipulation anyway by just basically doing government policy along these lines. You follow me so far? Mm-hmm. So if you're a smart multinational manager and you're trying to figure out, what do I want to do with my money, where do I want to invest it, and so on, you want to figure out what the value of the US dollar is. Quite honestly, look at what the government's doing.